the Brooks Trading Course. This is the fourth of 4 videos on scalping. I'm going to continue giving more examples on scalps that traders can take if they're paying attention and are quick enough to see what's happening. A lot of traders do not like to trade on the 5-minute chart, and one of the reasons for that is if you're scalping, remember, it's hard to make money if the average bar is smaller than the average scalp. And most of the time on a 5-minute Forex chart, the average bar is less than 10 pips tall. That means it's smaller than the average scalp, and that means there are not that many scalping opportunities during the day. Some traders, instead of watching every 5-minute bar, will go to a higher time frame chart, like a 60-minute chart, and they'll scalp it as well. When the market looks like this, it's not going to go very far up, it's not going to go very far down, and you can see the range is small. It's only 30 pips from here to there. And some traders, even though this is a 60-minute chart, will scalp for 10 or 20 pips because the range is too small to scalp for more than that. And it's sideways for a couple of days, and if they want to do any trading, their only choice is to scalp or trade a different market. Sometimes you'll get a 60-minute chart that is in a very tight range, maybe only 20 pips tall for 20, 30, or 40 bars. Here, the range is about 30 pips, or mostly about 30 pips for about 60 or 70 bars. That's 60 or 70 hours. This is a 60-minute chart. In general, if you're scalping on any time frame in the Forex market, it's easier to wait for bars to be at least 20 pips tall. It's also easier to make money if the tight trading range is not too tight. For example, it's better if the range over the past 10 or 20 bars is at least 50 pips from top to bottom, 50 pips tall. But sometimes it's not, and when it's not, if you want to trade, you have to go for a smaller profit target. If you're looking to go for a minimum Forex scalp, which is 10 pips, it's easier to find trades if your average bar is at least 10 pips tall. And sometimes on a 60-minute chart, the bars are small. A 10 or 15 pip tall bar is small on the 60-minute chart. But if the bars are staying small, 10 to 20 pips tall, it's okay to scalp for 10 to 20 pips, even on a 60-minute chart. Since it's a 60-minute chart, it takes an hour for one of those 10 pip or 20 pip tall bars to form, and that means you will not get many trades per session. In general, as a guideline, if you're going for a 10 pip scalp, an initial stop is probably 3 times bigger than your target, your reward. By using a 30 pip stop to make a 10 pip profit, it allows you the possibility to scale in if you need to scale in. Why scale in? It adds risk, but it increases the probability of making money, and that's why a lot of traders scale in. At this point, we have 4 consecutive bear bars, decent-sized bodies, several closing below the midpoint. It's strong enough so that any bounce will probably find sellers, and we should get at least a small second leg down. Also, this bull bar, you can argue it's a failed bear breakout. This little bull bar with a tail on top and a small body is probably not strong enough to reverse this bear trend. Because of that, traders will sell at the high of this bar. They'll get filled here. They'll use a wide stop, maybe up here, and they're willing to scale in higher, betting that the reversal up will fail after such a strong sell-off. That is a high probability bet. Because we can get easily a 50% pullback, any trader taking this short needs a wide stop. They could put it above the top of this channel. I think of this as a spike and then a channel down, or they could put it all the way above the top of the bear trend. In general, I tend to favor wider stops initially. I never plan to let them get hit, and I usually exit before they get hit, but they give me a higher probability of success, and they give me more room for scaling in. If you're thinking that the bars are getting small and the market's probably not going to go very far for several bars, you can scalp out with 10 pips profit or 20 pips profit. When you take the trade selling here, you decide what you're going to try to get, 10 pips or 20 pips, and you place a limit order. Some bears will exit with 10 pips here. Some will exit with 20 pips here. They see their entry price right there. They place a limit order 20 pips below. It went a little bit below that, and they got filled. The trend went down a little bit more, but now we're trying to reverse again. So bad follow through, 4 bear bars, a bull bar, a bear bar, a bull bar, a bear bar, a bull bar. This is trading range price action. And it increases the chances that we'll start to go sideways soon. A big bear trend bar. Every trend bar is a climax. This is a sell climax. This is a sell climax. This is a sell climax. And we're starting to reverse up from a possible final flag. A small trading range relatively late in a bear trend might be the final flag before the market transitions into a trading range. When you have a series of sell climaxes, the market often tries to get up to the top of the most recent sell climax. It also tries to get up to the 20-bar exponential moving average. And therefore, we have a magnet at this price level right around here. A lot of the bears who sold for any reason are disappointed by the follow-through. Bear bar, bull bar, bear bar, bull bar. Too much risk that this is the beginning of a trading range, that this is a bear leg and what will be a trading range instead of a bear trend that will continue a long way. And therefore, bears who sold for any reason, let's say they did not exit here or here, and they see this bull bar, a lot of the bears will buy back their shorts on the close of that bull bar. And you can see what happened after this bear bar. Bears were disappointed by this bull bar, thinking that, instead of a series of bear bars as we had here, we're getting bad follow-through again. The trend is weakening. And a lot of bears, let's say they sold that close, and they see this bull bar, they decide, this isn't working out. I'll just place a limit order to get out at my original entry price, the close of this bar. And you can see what happened. Once this bull bar closed, the market dipped slightly below that close, and instead of forming another bear bar, it reversed up. That tells you that bears who sold this close were disappointed by this bull bar, and they bought back their shorts here. The bulls see that as well. Instead of the bears holding on to their shorts, we're bouncing. Where are the sellers? There are no sellers. In fact, this is probably in part caused by disappointed bears buying back their shorts. And bulls see the trading range behavior here. Consecutive sell climaxes, bad follow through, bad follow through, bad follow through, bears giving up. They'll buy with a stop above the high of this bar or on the close of this bar once they see that it does not have a bear close. They're looking for a scalp up to the top of the most recent sell climax bar and a test of the moving average. Not a very big bar. The bulls who bought above this bar are disappointed by their entry bar. A lot of them, instead of trying to get up here and at the moving average, will decide that maybe I'll just take 10 pips. We're starting to get small doji bars, and we might enter a tight trading range, especially toward the end of the U.S. session, so they could scalp out with 10 pips. A bull could also still hold for a test of the top of the sell climax bar, and that would be a 20 pips profit if it got up there. What happened up here? The bulls had a breakout and ended up as a bear doji, but at one point this was a bull breakout above the moving average, It did not get to the top of the sell climax bar, and it reversed down. What does that tell you? It tells you that it's the opposite of what took place here. The bears gave up after this bad follow through, and they bought back their shorts. The bulls gave up on the test of the high of this bar. It did not quite get there. Too many bulls looking to sell out of their longs up here and at the moving average. Also, it's a 20 gap bar sell. I don't know if it's 20 bars, but it's about 20 bars, and it's near the top of this sell climax bar, and therefore bulls will sell and bears will sell as well, knowing that the bulls will sell. If a bull did not exit with a 10 pip profit here, and you saw this reversal down at the moving average, he knows it's a 20 gap bar sell. He will sell out of his longs on that reversal down. I know this does not look like a wedge, but we had a rally, and then a pullback, and then another rally, and then a pullback, and then another rally. The bulls 3 times tried to break into a swing up. I don't care if you call it a triangle or a tight trading range with a false breakout above the double top. To me, it's a type of wedge, even though this high is below that high. The forces are the same as a wedge, but you can call it whatever you want, a tight trading range. And therefore, after 3 attempts to reverse up, all failing, you have to assume that the market's probably going to try to get a test back down. As I said, it's also a 20 gap bar sell. You can also view it as a low too short. We have a rally here for 6 bars, 5 bars, and then a pullback into a triangle, and then a second rally and a reversal down. So low 1, low 2, or as I said, you can simply call it a triangle or a tight trading range, failed bull breakout and reversal down, near important resistance, the top of the sell climax, and at the 20 bar exponential moving average. So we're getting a reversal down at the moving average for the bear body. Even though it's a doji, it's a reasonable sell looking for a test back down. Some bears will sell that and they'll say, well, tight trading range for about 10 or 15 bars, probably not going all that far. So I'll sell it, put a stop above the top, and go for a 10 pip or a 20 pip profit, expecting that the market will probably find support around the prior low and will probably enter a trading range. Look what happened at the test of the low. We reversed up. That's what that tail is. The bears tried to resume down again, and we reversed up again, and a bull bar closing above its midpoint, and a big bull body compared to all of these bars. The bars are getting bigger. We have more chance of bigger moves now that the bodies are getting bigger. At this prior low, we reversed up. We tried to break to the downside again. We reversed up again on this bull bar. For the bears, they see this bull bar as simply a pullback from this breakout below this bear flag and the attempted breakout below the prior low. And therefore, it's a breakout pullback short below this low. But if you're a bear, do you really want to take that sell? We just reverse up here. What is more likely? A lot of sellers below this bull bar or a lot of buyers below this bull bar? We're probably in a trading range. It's better to look to buy low and sell high, not low. This is high. This is low. And therefore, this is the buy zone. And you can see bulls bought. Bulls bought. If it gets below this bull bar, probably more buyers than sellers. That's a bad sell signal bar. It's bad for several reasons. Bottom of a trading range, probably buyers. And it's a big bull body, a low probability sell signal bar. A big bull body at the bottom of a trading range means low probability. A big bull body means if you sell below it, your stop is far because the bar is big. That means the probability of profit is small. Selling below this bar, therefore, has a low probability of success, selling at the bottom of a range, and a high risk. Your stop is far away. Therefore, there are probably more buyers at that low than sellers. Because of that, smart bulls will place a limit order after the close of that bar to buy at the low of that bar or at the low of this bar, betting that the bears will give up as they did here, and bulls will keep buying, and it'll go up at least enough for a scalp. You're buying at the bottom of a trading range. The market might fall for a measured move down, unlikely to fall much more than that. Many of the bulls who buy here will place a stop just below a measured move down, either from the height of these two bars or from the height of the whole trading range. They'll put their stop just below it. And a lot of the bulls who buy here are willing to scale in more lower. If they add to their position, they want their second entry to be at least the size of a scalp below their first. That means they want to buy at least 10 pips below. If the market just goes straight up, they'll take their profits. But if instead it starts to go a little bit lower, they'll buy more. Here, they could place a limit order to get out around 10 pips up. If they want, they can try to get out 20 pips up, but that is around the moving average. And the market sold off there several times here, and it might sell off before it reaches a 20 pip profit. For the bulls, strong bear trend, a bull breakout, not all that strong, but we went up for about 10 or 15 bars, certainly sideways for 10 or 15 bars. And we're trying to reverse up once, twice, and now a third time. This is an attempt at a slightly lower low major trend reversal. And now we have consecutive bull bars closing above their midpoints, this one closing on its high. It's actually a reasonable buy. Maybe we'll get a breakout above this neckline. We have a double bottom, slightly lower low, but a double bottom neckline. Maybe we'll go up for a measured move up. The problem that the bulls have is probability. You're buying at the top of a relatively tight range. And trading range breakouts have a low probability. Trading ranges have inertia. They tend to continue. Another problem the bulls have is they're buying right below the moving average, and the market has been failing to go above it many times previously. And you can see the big tails at the moving average. Tail, tail, tail. So this is a resistance level, and the market might not go much higher. It's a reasonable buy, certainly for a swing up. We have a lower low major trend reversal, and we have 3 reversals up. Reasonable to buy for a swing. Is the probability high enough for a scalp? If you're buying above the high of this bar, stop below, you're risking about 20 pips to make 10 pips, but you're buying right below resistance. Is that good enough for a scalp? Probably not, unless you're willing to use a wide stop and scale in lower. If a person did buy on a stop above the high of this bull bar, they were a little disappointed by the size of the entry bar, and then many would exit on the close of this second bar, because instead of breaking strongly above the moving average, we're getting small bars. The bulls are not getting the momentum that they hoped, and a lot of them will be disappointed. And after a couple bars, 2 or 3 bars, they'll start to sell out of their longs, giving up. Bears know it's a tight trading range. It's also a tight trading range in a bear trend. Even though the bulls are reversing up repeatedly through here, they still have not broken strongly above the moving average. And a lot of bears will just keep selling at the moving average until the market breaks strongly above. So some bears sold here, made a profit. They sold with a limit order here, made a profit. They sold here, made a profit. This is less probability than these shorts, because now the bulls are starting to get bars closing on their highs. But a lot of the bears will see the small bodies after this buy, and they know a lot of the bulls will give up, and therefore bears will sell right around the moving average, maybe the close of this bar, once they see that it has a very small bull body. These bears are not expecting a trend down. They're just looking for a scalp. And therefore, they'll place a limit order to buy back their shorts 10 pips lower. Some will hold for a swing, hoping that the bear trend will resume. But with all of this tight trading range price action and many reversals, I would rather only scalp. This is the euro versus the dollar, a 240-minute chart, and we have a very strong reversal. We have about 10 consecutive bull bars, many of them with closes above their midpoints and near their highs. That is a strong enough reversal up so that the first sell-off probably will form a higher low. The bulls will buy again, even though we have not yet gone above a major lower high here or the top of the bear channel. The bears see this strong reversal up as simply a test of this high, therefore a double top. They see it as simply a double top bear flag, and they're looking to sell up here, expecting a breakout below the neckline of the double top and maybe a fall for a measured move down, even with the rally as strong as it is. We have a very big bull bar here late in the rally. It's probably an exhaustive end of the rally and not the beginning of a strong bull trend. It's probably a buy vacuum test of resistance. And you can see it raced up. It could not get above this major lower high. It's a bull breakout above a bull channel and it's reversing down. Probably we'll get at least a couple small legs sideways to down. We have a bear inside bar. So we have a bear reversal bar and a follow through bar. A lot of bears will sell this, at least for a scalp, betting that we'll get a trading range instead of a bull trend. Obvious stop above the top of this bear bar or above the double top. This box, the height of this orange box, gold box, is 50 pips tall. You can see a lot of the bars are about that size or even bigger. Should you be scalping for 10 pips when all the bars are 50 pips tall or more? No, of course not. You should be going for a bigger profit, maybe the size of an average bar, 50 pips. And you can see what happened when it fell 50 pips. The bar had a big tail below. What does that tell you? It tells you that a lot of the bears who did sell below this bar were scalping for about 50 pips. They also got out around the 50% retracement of this rally, thinking that this is such a strong rally, probably bulls will start buying about 50% down, looking for maybe a higher low major trend reversal. So bear trend, strong bull breakout, higher low. I know this does not look like a channel, but a lot of computers will look for a channel. When they see a reversal down, they'll look for a possible start to the channel to the left. And sometimes it's only a small bar like this. If you want, you can also say, well, we have a double top and we're breaking above the double top. And now we have a bear bar. We're reversing down. That is also a type of wedge. Anytime you have a double top and a bull breakout that reverses down, you have 3 pushes up, 1, 2 in the double top. And then the breakout that reverses down is the 3rd push up. So a failed breakout above a double top has the same forces as a wedge. And therefore, if it reverses down, you're probably going to get at least a couple legs down. Also, as strong as this is and as strong as this is, the bulls could not get above the top of the bear leg. They got above the top of this sell climax, this final leg down, but they could not get above the top of the bear leg. And therefore, the market's probably in a trading range. And a trading range means we're probably going to get a swing down. Trading ranges have legs that go down, legs that go up, and legs that go down again. With that big tail on top and the close below these lows, some bears will sell that close. Others will sell on the reversal down, either below that bull bar or below the bear bar. A lot of traders, if they're entering with stops, prefer to sell below bear bars. Reasonable stop above the top of the entire range. Again, since a lot of the bars are about 50 pips tall, and therefore scalping for 10 pips or 20 pips is too small, the next logical scalp size that traders use is usually about 50 pips. So they'll think of 10 pips, 20 pips, and then maybe jump to 40 or 50 pips. And since the average bar is 50 pips tall or higher, a lot of the traders will look to take profits at 50 pips. Remember my 80% rule. 80% of breakout attempts within a trading range will fail. A lot of times if you have two resistance levels, this high and then that high, the market will go above one, but reverse down below the other. And that's a common occurrence in a trading range. And if you see it, you see the market breaking above one, but not above the other and reversing, that's a sign that the market's probably in a trading range and that you're probably near the top. We have a failed breakout above a double top, and now we have a pair of bear bars closing below their midpoints and having pretty good size bear bodies. That tells you that the bulls who bought for any reason are finally giving up. They have a good rally. They have a second leg up, which was likely after the first rally. But with the reversal down, they're no longer expecting a third and fourth leg up. They're now thinking that this is probably going to be a trading range, and the bulls are giving up. They're giving up on their hope that this is the start of a strong bull trend. They don't want to see the market turn down sharply at resistance and then break out again, but turn down sharply at resistance. That's much more common in a trading range than in a bull trend. And therefore, the bulls are changing their premise. Instead of hoping that this is the start of a bull trend, they're thinking that, well, maybe it's just two legs up in a trading range, and this is where they're giving up. Because of that, bears will start looking to sell closes, maybe on the close of the second bear bar or the third bear close right there, looking for at least a couple legs down. At this point, we have 6 consecutive bear bars. Well, you can say that it's 5 bear bars in a doji, but it's 6 bars without a bull body. Chances are the first reversal up will form a lower high. Chances are there'll be sellers above. The bulls are hoping that this is a double bottom higher low. I know that these lows are not at the same level, but a lot of computers will see that as a double bottom. This is the neckline, and they want the breakout to a measured move up. The bulls are hoping that this is the start of a broad bull channel, deep pullbacks after every new high, but that it goes up for many, many bars. It's probably not. It's probably a trading range, but the bulls are hoping that it's the start of a swing up. They're also thinking maybe it's a wedge bull flag. We have a push down, a pullback, a push down, and then a pullback by the close of the bar, and a third push down. So maybe it's a wedge bull flag. Bull trend, bull breakout to a high, and then a pullback to a wedge bull flag, and they want trend resumption up. After 6 bear bars, probability is there are sellers above, and the market will form a lower high and get a second leg down. And therefore, it's more likely that there are sellers at the high of this bar and higher than there are buyers. Bears will sell at the high of this bar, willing to sell more higher, and the bears who did sell this close or that close will not exit above this bar because they know the odds are there'll be sellers above and will go lower. These bears are still trying to get out with a 50 pip profit. They have a limit order to get out, and they finally got filled over here. Remember, I said this was strong enough down to get a second leg down, so 1 pullback, 2 or 2. Also, we're in a trading range, and trading ranges often have two-legged moves. 1 pullback, 2, 1 pullback, 2. They never look like two-legged moves as they're forming. But when you print out the chart at the end of the trading, you'll say, wait a minute, this is a whole bunch of two-legged moves. And that's what I expected in a trading range. We had a very strong reversal up and a good second leg up. Probably some buyers somewhere below. We bought here, about the same price level. We're down to that general area again. Probably the bulls will start buying again. Instead of 6 bear bars, we got a bull bar. We have a bull bar. And now we have a bull bar closing on its high. The market traded above its high. It tried to go lower, and then we immediately had another bull bar closing on its high. And we have a double bottom with this low. And we have a trading range. If you want, you can call it a wedge. 1, pullback, 2, pullback, 3. For me, we might be forming a trading range here around this low, and this would be a second entry buy. It's also a higher low major trend reversal. Bear trend, very strong breakout. We tried to get a higher low here, but 4 bear bars, not many traders would buy it. Now we have a double bottom higher low. This is slightly above that, but it's still a higher low compared to this. So I call it a double bottom higher low major trend reversal with a second entry buy. First entry of that bar, second entry here. It's a reasonable buy for a scalp or a swing. High probability buy. It should not come back down here if it's going to work, and therefore traders can use a tight stop right below the low of this micro double bottom. Down, up, closing on its high. The market should go higher. Because of all the trading range price action, a lot of traders will simply continue to scalp for 50 pips. They buy above this bar, they get filled here, they place a limit order to exit 50 pips higher, and they exit right there. It's trying to go sideways, down and up and down and up and down and up. We have 2 small dojis, and then we have a big bull bar, but a big tail down and up. It's another doji, and now we have a doji here as well. This rally looks like it's a bull leg in a trading range instead of the start of a bull trend. And we're near an area where the market sold off repeatedly. It sold off here, 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 and then on this bar, it sold off here. It tried to go up, and it sold off again. This is probably the top of a developing trading range. If you want, you can call it a wedge. First push up, sell off. And then second push up, this tail or this bar, sell off. And then a third push up, trying to break out to the upside. And now a micro double top. Up, down, down. Probably we'll get a couple small legs down, and therefore bears will sell with a stop below that bear bar, looking for a couple small legs down. 1, pullback, 2. Place a limit order to buy back the shorts 50 pips lower. And look what happened when the market got near the limit order. It did not get to the middle of this blue box, which is where the limit order is. It turned up. The profit-taking limit order did not get filled. This could be a pullback from a breakout of a bull flag. Remember, this is a double bottom, higher low major trend reversal. This is a wedge bull flag and a pretty good breakout, even with the stall at the top. This could simply be a pullback from this breakout of this bear channel bull flag. And now we have a bull bar closing on its high. Even though it's a bunch of dojis, a lot of the bears who sold here wanted the 50 pips profit. It got very close to their target, and now it's right back near their entry price. A lot of them will buy back their shorts above this bull bar. When the market gets really close to your target but does not fill you, and then it quickly starts to go back to your entry price, if you're scalping, it's usually better just to get out. We broke to a new high again above this high, above that high, big tail, and then big tail, and now a bear bar. If you want, you can call it another wedge. 3 pushes up, 1 down, 2 down, 3. And it's still below the top of the trading range. But now we have 5 consecutive bull bars, 4 of them closing above their midpoints, and 2 of them having pretty good sized bull bodies. That's good buying pressure. The bears will keep selling reversals, betting that the trading range will continue. Instead of selling with a stop, a lot of them will sell the close of the bad follow-through bar. We have a bull breakout attempt, good bull bar, and the bulls wanted another consecutive bull bar and follow through. Instead, they have a bear bar. Even though it's a doji, it's still a bear body. And some bears will sell that close, betting that will pull back at least enough for a scalp. Not only did we pull back enough for a scalp, it reversed down. Bull breakout, bear reversal. The bears who took that sell, who sold that close, placed a limit order to buy back their shorts 50 pips lower at the bottom of the most recent buy climax. Usually there's some buying there. Probably, I don't have it measured here, but it looks like the bears who sold on a stop below that bear doji probably made money as well. Three pushes up, 1, 2, and then 3, another reversal down, and these two reversals down have pretty good bear bodies closing on their lows. You can call it a small double top or a micro double top and a slightly lower high at an area where the market has turned down repeatedly. Top of a trading range. Now we have a micro double top or a wedge and a slightly lower high. You can call it a head and shoulders top, left shoulder, head, right shoulder. You can call it a bull trend and a lower high major trend reversal. Reasonable to sell with a stop below the low of that bear bar. You get filled right here. A wedge, lower high, major trend reversal. Bull trend, bear breakout, a lower high, and it's a wedge, 1, 2, 3, or a double top. It's still a trading range, so a lot of these bears will exit with about a 50 pip profit somewhere down here. Traders were selling up here, the sell zone, top of the range, and they were buying here, here. You can see this price level, this general price level. They bought, they bought, they bought, they bought, they bought, they bought, and they're buying here as well. The market has a weak sell-off to test the bottom of that sell climax. Weak, we have a couple of small bear bars, a bull bar, a bear bar, a doji, a bear bar, a bull bar. This looks like a bear leg in a trading range. And it's a test of this low close. The sell the close bears are happy to get out break even after this strong reversal up. So bears will be buying here and bulls will be buying as well. We're in the buy zone and the screen is in a trading range. We're low in the trading range. Bulls will buy on the reversal up above that bull bar. A wedge, 3 pushes down, down, pause, down, and then reversal up. On a smaller time frame chart, that'll be a wedge test of this low. Traders would place a limit order to sell out about 50 pips higher. And they would get filled there. In this video, I gave examples of other scalps, including some on higher time frame charts. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on scalping.